Pues como decimos, estamos ya de vuelta y con el foco puesto en las oportunidades de inversión que contempla en estos momentos BNY Mellon. Vamos a hablar de cuál es la fotografía que nos desgranan respecto a los mercados, temores de recesión, pero sobre todo nos vamos a centrar en la estrategia, en las oportunidades de inversión que contemplan en estos momentos y poniendo el foco especialmente, en concreto, en el high yield, y también vamos a ver un poco, nos vamos a acercar a las divisas, cuáles son las perspectivas respecto a la evolución del euro-dólar, qué podemos esperar de la divisa del euro, de la divisa estadounidense a lo largo de este año, después de un 2022, sobre todo en el que destacaba la fortaleza del dólar estadounidense y por contraparte, la debilidad del euro. Bien, pues como decimos, nos acercamos a todas estas cuestiones con BNY Mellon y hablamos con el Senior Market Strategist, con Sebastian Vismara. Sebastian, thank you so much for having us a few minutes.
Thank you for having me here today.
We have a difficult market situation and with all the uncertainties from 2022 and 2023 is not an exception, but which is your general vision of the current situation?
Sure. So you're right, 2022 was a very difficult year. 2023 started a little bit easier. The market was pricing in a soft landing, so the idea that inflation would move back to 2% without a recession. The market is getting to conclude that that's going to be pretty unlikely. It's most likely, given the reacceleration that we have seen, particularly in the US, that recession is delayed, but the economy remains too strong for inflation to go back to 2%. So that is leading to expectations of further interest rate hikes from the Fed. Also from the ECB, the inflation data is not yet showing enough weakening for the ECB to stop, and that is quite unnerving markets quite a lot. And so really the view is that the challenge will continue for some time. Our view is that ultimately a recession is quite likely, but perhaps towards the end of the year, and that we will see further rate hikes in the short term.
Yeah, as you say, we still see these pressures on inflation, general inflation and core inflation, of course, and the ECB changed its focus from the general inflation to the core inflation because, today we had the CPI in Spain and in France, and it's, of course, the situation that we have right now in Europe. Do you think, like we are seeing right now, that the ECB can extend its hikes to February 2024, as we are seeing now because in fixed income, for example, in Germany, the Bund 10 years and 2 years, we are seeing how it's escalating its positions?
I think the market is drawing too much of a parallel between the US and in Europe. I do think that they remain quite distinct in the type of shocks that they have faced. The US economy remains much stronger than the European economy. We have seen weaker domestic demand at the end of last year in Europe. You have seen weakening in some of the economies. There are some technical factors related to the Irish contribution to growth, which might be distorting the overall growth picture in the euro area. So I do think that it's quite unlikely that the ECB will be hiking until the start of 2024. Our view is that most likely it will stop by the mid of this year. So it will deliver further rate hikes. But by the mid of this year, it will have become more clear that inflation, including core, is falling, that the trend in inflation is moving in the right direction. The economy remains pretty weak, and there's a lot of impact from monetary policy that is still to come. The lagged effects of monetary policy, we haven't seen really as much coming through yet, and we will see, we think, more in 2023. So unlikely that they will hike until start of 2024. So
your vision is more in line with Villeroy, for example, the ECB member who said the pause could start by summer, approx, isn't it?
Yes.
Okay.
Yeah, I agree. I think, in March the ECB will reassess the situation. The recent core inflation prints do not help, particularly in Spain and France. I do think, however, that by the summer, it will have become more visible the impact that the tightening of monetary policy is having on the euro area economy. Yeah.
Well, we will expect to know all this information to take a picture of all of it. Why do you think, why do you find, talking about investment opportunities, why do you find interesting right now high yield assets?
Yeah, so high yield is an interesting one. Generally speaking, as an asset class, it's providing income returns for, income returns have increased quite a bit over the past year or so, given the rise in interest rates from central banks, the rise in spreads. We would prefer taking short-dated exposures, actively managed exposures, and that is because there's more visibility in terms of the companies. And if you're taking short-dated exposures, the income return is really good, and it's actually higher than the return that you would get from longer-term exposures because of the inversion in the yield curve. So, that income component is starting to become significantly more attractive compared to past years, and we think investors should play that theme.
In 2022, we saw a weakening euro and strong dollar. What can we expect now from the evolution of these two forex when we try to have in mind this picture of all this evolution and development?
Yeah, so FX is an interesting one. It's obviously driven by the relative performance of the economies, by relative monetary policy. And as I mentioned earlier, we think that the US economy remains fundamentally stronger than the European economy. So as you mentioned, the dollar was quite strong last year. At the start of this year, we saw some euro strength on the back of ECB becoming more hawkish and surprising the market. But ultimately, we think if there's a risk of higher interest rates at relative to what is priced in the market, we should look to the US. And so we do think that will continue driving dollar strength. We don't think we will see as much strength as we have seen last year, but fundamentally this supports the dollar throughout this year. And if we get a recession, recessions mean high risk aversion from investors, and that is also usually positive for the dollar. So we remain constructive on the dollar relative to the euro.
Now that you mentioned recession, which is your point about these recession threats, so we lived here when we were worried about this scenario in Europe, in the US. Well, in the US, we have to take in mind that in the First and Second War in 2022, we had a technical recession, but then we in the United States, they experimented a GDP expansion again. What about this year in the United States and in Europe? Because now in Finland, they are talking about a technical recession too.
Yeah. Yes, so the US economy remains strong. It remains too strong for inflation to move back to 2%. The second half of last year was pretty robust. Indicators of near-term growth, so the models we use to assess what might happen this quarter, given we don't have data yet in terms of GDP, are still pointing to a robust growth. But that means further interest rate hikes. Also, we and many others have been perhaps a bit surprised by the fact that employment has remained so robust. So we have seen some pockets of weakness in the US economy. So the construction sector has weakened quite a bit. But employment in that sector, for instance, has remained very resilient. So I'd say cutting some of the transmission channel from tighter monetary policy. So that means that recession is delayed, and it means that we will see further rate hikes. Our view is that most likely it will happen in the second half of this year. There is a chance that interest rates will continue rising. They will remain high, and recession happens in 2024 as interest rates remain high for some time. But we do think that recession ultimately is the way that central banks will sort of resolve this inflation problem and the fundamental issues, imbalances in the labor market. In Europe, the situation is different. So the economy is weaker. Domestic growth has been quite weak. Has been quite weak in some countries, in Germany, for example, Finland, you mentioned, and some others as well. And the ECB started later, so we haven't yet seen the full impact of those rate rises from last year. So whilst for the US we're a bit puzzled as to why employment hasn't really moved as much, we don't have this information yet for the euro area, and there's reasons to be a bit skeptical that might happen in the region, in this region as well. So our view is that a recession in Europe is quite likely this year, and more likely than for the US.
Yes, and Sebastian, we talked about, in terms of investment opportunities, we talked about high yield assets. Which other investment opportunities you are focusing in?
Yes. So we remain, broadly speaking, we remain defensive, but tilted towards fixed income, trying to pick up where we see, income returns contributing to meaningfully to total returns. Income returns can provide a cushion to some price return volatility that we expect. So in terms of fixed income, we mentioned high yield, but mostly short dated exposures. We think those are most attractive. Generally speaking, we favor sovereigns over IG, investment grade over high yield, broadly speaking. But again, one needs to be quite selective. We like active exposures, active type of investments. For the moment, we think cash also is a good investment because it provides optionality. So when there is a market sell-off, one can invest some of that cash to pick up greater yield or better price returns expectations. Within assets, for instance, equities, we favor defensives, as I mentioned, over cyclicals, quality assets, generally speaking.
And if we have in mind all this last year with the war in Ukraine, last week we talked about the first anniversary of the war. Which has been the impact on markets, and what do you think about this year? Do you think markets are nervous or worried about the resolution of this conflict?
Yes, so the impact on markets has been an interesting one, because on the start of the event, 1 year more or less ago, obviously, we saw huge reactions in risky assets, huge reaction in oil and gas and so on. Much of that has retraced. So the oil price, for instance, now is below the level just before the start of the war. I think markets might be a little bit complacent. They're expecting sort of frozen conflict, nothing really major happening. I think it is to some extent a reasonable expectation. We have seen this happening elsewhere historically in the world, but there's plenty of risks really of an escalation of the situation there. So, we're watching nervously the events there.
That's important. Sebastian Vismara, thank you so much. It's been a pleasure.